Thank you, everyone. First, a few couple of opening remarks. First of all, it truly is an honor and a pleasure to be here. I know you hear that said a lot. Why is it an honor? Because of my almost 50 years in financial aid. I always worked for APC schools, and this is my first APC meeting. So therefore, an honor, and I mean it. A pleasure because I've been busy giving a lot of training via the webinar, okay? Literally, I've trained approaching 4, maybe more, 1,000 people about SOAR, schedule of reduction, which will not be the focus. It'll be partially that. It's just a pleasure to be talking to faces rather than to my screen and looking at my dog to the right and my wife in the background. So truly an honor and a pleasure. Now, when I come to a conference, I say to myself, if I learn 1 or 2 things, spectacular. If I learn more than that, I get really angry at myself that I should have known that before even coming to the conference. That's just who I am. I know APC schools. I've worked for 3 of you and actually consulted with a few others. And honestly, I find you people to be the smartest, sharpest people in town. And I've worked with a lot. So if I hope to be able to impart things that you know, that you don't know, or haven't thought about yet, if I haven't, it's because you're that good, and it's not my fault. So don't look at me as the responsible person. So first of all, it's not the first time you've heard this, is the elimination of the Grad Plus loans, and also the reduction, or rather now the limit on how much parent loans could be borrowed. So let me just start with those 2 things as a top priority. So you've heard about it, but my question to you, and I started giving these presentations back in March, April, and May. So what you should be doing now I should say what you really should have done already, but if you haven't, then I hope to bring it to your attention. For example, your Grad Plus students. Have you done the study on how that's going to impact your students and be able to afford attendance? Have you done that research? Have you figured out how to possibly alternative funding, which I'll get into? Have you looked into that? I mean, these are things that you really should have done, and if you haven't, please do it now. And the same thing with parent loans. Parent loans up till now, it's been the cost of attendance, less other financial aid, and the parent loan could have been $40,000. That's no longer the case. Now it's going to be $20,000 a year and a total of $65,000 total. So that doesn't make for 4 years of $20,000, does it, if you're a 4-year program? So again, I would find the research, do the research, and find out how is this going to impact your students, and whatever impacts your students obviously impacts you, your revenue, your student body, and all those important things. So if you haven't done that already, I'm suggesting that you do that, call someone as soon as this meeting is over, before you have the cocktail, and call the appropriate people to get work on it. You've heard this before, institutional authority. A lot of the things here has been said already today in a little bit, but I'll give you a little bit of different taste on it. So in my opinion, this is not what we asked for. I'll disagree with the Undersecretary. We have not asked for this for years. We've asked for this for over 4 decades. But what we wanted was the immune ability to say, you are not going to take out more than this amount of loan, or a student who's in your face who says, I don't plan on paying back these loans, that kind of thing. We wanted that kind of authority. But to actually limit the ability of a program, and when it's a program, it's actually 2 programs. You could limit the loan programs itself, so you could put a limitation on plus versus subsidized and unsubsidized student loans, or you could do it program by program within your institution. So the only real good reason why I thought of that possibility of instituting this was actually brought up in a conversation earlier. You were here for that, so I'm not going to get into that again. The interim exception. Now, the interim exception is under let's put it this way. There's one part of the interim exception that is being challenged in the lawsuits that the ladies mentioned earlier. One of the reasons that it's being challenged is because it was not in the statute that if a student drops out of a program, that they lose the exception. That was not in the law. They added that in the regulation, and that is being challenged, especially for implementation as early as July 1st. So that is being challenged. The only kind of drop or leave from a program that is possible, and I don't think any of the schools here, is what's called a official leave of absence, approved leave of absence. For those of you that don't know what that is, that's a school that could actually allow a student back in any time they want. And that's the only time that would be considered an officially approved leave of absence. You actually report that student as in school to NSLDS and the clearinghouse through to the NSLDS. So I won't go any more into the interim exception. I think you're all pretty familiar with that. But what I do want to bring up is, well, I think I have a slide on that, so hold on a second. I'm not gonna. So what we do know is that in the law, so this is not regulatory, it's in the law that interim exception should be measured based on the number of semesters it takes for a student to graduate at full time. That's in the law. It's not in the reg, it's in the law. So what happens to your part-time students? They'll quickly run out of the interim exception. Very, very quickly. So that's not, so SOAR, schedule of reduction, is not the only thing that's going to be really hurting the part-time students. So do keep that in mind. So I mean, basically it's a hot mess is what I put here, and I'm expecting more guidance on interim exception. And the bottom line is how are they going to track it? So what they decided to do was, in my opinion, they should be tracking it strictly through NSLDS, because NSLDS has the attendance. Therefore, part-time students versus full-time students, that makes the most sense to me. That's not what they did, so whatever. So what they did is they implemented COD to do the tracking, to let you know, basically, if the student is potentially eligible for the interim exception. What they're doing, which again makes no sense to me, that's why I said it's a hot mess, they're only considering students who took out a loan, dispersed a loan in 25, 26, by April 20th, I think is the date. So what happens to the student that is before that, continued school, earned a giant scholarship, mom and dad got a lottery or whatever, and did not take out a loan in 25, 26. So initially, they were saying that you would have to report that to the FSA, to the Department of COD, by telephone, that this school is eligible for the interim exception. Then the question came in during one of the webinars, do you mean we have to call, if we have 100 students, we have to make 100 phone calls? I couldn't answer that question, but it seems that they are putting together some technological measure to be able to flag the student as someone, as you know, who is eligible for the interim exception. But that's only half the story. That means they had a loan, so interim exception. They were enrolled in a program by June 30th of this year, that's in a couple of days, and a loan was dispersed. Now, that means any new graduate students, cannot be eligible for Grad Plus. It's just not possible. And it was mentioned that I'm working, I think it was mentioned that I'm working as a consultant for many schools. This one school in Missouri, I will not mention names, one school in Missouri I'm working for, and I asked for the grad school data, the Grad Plus data, and I asked, other questions. I got 0 responses from them. They're not as together as APC. So I'm working together with a tech person who's at the school, and I said, pull the data for me. It so happens they had already packaged over 20 students with Grad Plus. New students. So in my weekly report is simply in bold, giant caps, you're out of compliance. And you're now going to have to reverse that and explain to your students, your new students, why they can't get as much money as you originally said. So you have to be careful with that. The latest interim exception news is but it's not news anymore. When I created this, I thought it was so cute and adorable, and it's no longer news. I figured I'd leave it in anyway, because I could be sneaky. Who remembers Car 54? Where are you? Okay, so that's what I was thinking about at the time. Code 352 guidance, where are you? We were getting a lot of C flags, okay, that related to code 352. 352 is COD telling you, the school, that these students meet the first part of the interim exception. They had a loan, was enrolled, they had a loan dispersed before July 1st, enrolled by June 30th. To me, they say that the same way, but it means to me the same thing, doesn't it? Before July 1st and by June 30th. No, but anyway, with that said, they did finally come out with some guidance that effective immediately you could ignore the C flag that was coming with the 352. The common code exists, 352, that's still good. It lets us know whether or not COD thinks they're eligible for the interim exception, and if they're not, and you think they are, this tells you you need to go in and tell them otherwise. So what should you be doing now? You should be going through all the ISERs you're coming in through, not one by one, I'm talking about your automated systems, doing research, who has a 352, who you think should have a 352, and those that don't, report that to COD. So that's an action. Now, is that something I think everyone just learned today? I'm trying here. Okay, SOAR, the schedule of reduction, first of all, it is not. This is what I've been focusing most of my attention on, but only a little bit. Am I in your way? I'm sorry. Okay. So SOAR, schedule of reduction, is what I've been mostly focused on over the last several months. It is not proration. Loan proration has existed for decades. Loan proration is when a student is graduating with only one semester in a 2-semester program, or possibly 2 semesters in a 3-semester program, but they don't have a full academic award year to graduate, and then you have to do loan proration. Now, that's why schedule of reduction is specifically that. It is schedule of reduction, and it happens as you go along. It's not just for graduating students. And I think we already explained what schedule of reduction is earlier, so I'm not going to go into those details. I do give a few examples here. And so a student who is part-time in term 1 and term 2. Are you sure I'm not in your way? Student is a first-term dependent student. Term 1 equals 6 credits. Term 2 equals 9 credits. So term 1 plus term 2 equals 15 over 24, which is 62.5%, rounded to 63. Now, this is where the department is allowing you to round. You can't round at the semester level. It must be at the annual level that you round, and the rounding is simply if it's greater than 5% or greater, 0.5% or greater goes up, less goes down. And this is where that proration, reduction occurs. So continuing in example 1, determine the student's eligibility. Well, the student's a freshman, so $3,500. The calculated SOAR value would be $3,500 times 63, as we calculated before, equals 2205. And now they're allowing proportional or equal disbursements. Proportional would be exactly what they're taking in each semester, which makes a lot of sense to me. So in term 1, it was 6 over 15, so 40% of your 2205 would go there, and then 9 over 15, 60% of the 2205 would go in term 2. Or you could decide, and you could do this on a case-by-case basis. You don't have to do this as an institutional global policy, but your policy is that you do it, one or the other. Now, you do proportional, you do equal, or you do both based on the best interests of the student. I personally cannot see where it could possibly be in the best interest of the student unless there's some sort of like they're running out of tap in term 2. I mean, extraordinary circumstances. Why a school would want to do equal 50-50 term per term when obviously in term 1 they have more tuition. So why would you want to give 50% there and 50% where there's greater tuition? So extraordinary circumstances, this is why it can be on a case-by-case basis, but that would be the only time that I would expect people to be using the but someone could teach me wrong and tell me that there's better thinking than I am thinking. Student is sample 2, and I'm only giving 2 examples, I believe, and I'm going to give in one of the slides where you can see the 2.5-hour presentation I did on this. It was a 1.5-hour presentation with 1 hour of QA, and it's free. You can go on and you could watch the entire video. I recommend that your financial aid staff at minimum watch that or watch something like that. So the student is full-time in term 1 and 2. Student is a first-time dependent student. Student is registered full-time for both terms. So that's 12 credits and 12 credits, 50%, 50%. Plus 1, plus 2 equals 24 divided by 24 is 100%. Student doesn't have a SOAR situation. By the way, you can only apply proportional when there is a SOAR situation. Let me say that. What I said earlier about proportional, if there's no SOAR situation, schedule of reduction situation, it must be 50-50. And the equal disbursement, obviously, provision has been waived for SOAR situations, which is why the 50-50 is required if it's not a SOAR situation. So the student withdraws from a 3-credit course before disbursement in term 1, but must recalculate the entire first year. So the school must reduce the term 1 loan because it's before disbursement. We had that conversation earlier. If it's before disbursement, you have to recalculate the entire year first, okay, not just the term, but the entire year. So that calculation I showed earlier for the entire year would have to be redone. So now that would no longer be 24 over 24, it would be 21 over 24. Schools must then reduce the term 1 loan. They don't have the option of doing the second term. It must be done at a point of disbursement because it's before disbursement. Basically, I just said all that. So the big change is that schools are now allowed to actually originate loans presuming what the next semester is going to be. Up till now, we have not been able to do that, but now we can. That's also a big change with SOAR. Oh, some further guidance that I'm waiting for. First of all, I forgot to mention with proration plus SOAR, it makes no sense. But the guidance that we've received, and there's very little guidance on it, let's say the hints that we've received is that you have to do proration and then apply SOAR. That seems to me like double indemnity to me. So I don't know if that's right. We're waiting for more guidance on that. And the other things we're waiting for is on SAP. If a student, for example, is not eligible for a loan in term 1 and takes 6 credits out of pocket, can those 6 credits apply towards the schedule of reduction for the 2-term calculation? Okay, the conservative, which is traditional, thinking on this is that you cannot use those 6 credits. But again, we are waiting for more guidance on that. And we're also waiting for more guidance on SOAR and R2T4. What happens if a student fully withdraws? In term 1, what happens in term 2? In my opinion, what it's going to be, and again, there's no guidance on this, I'm just giving you my opinion, is that we've always had to recalculate the eligibility for term 2 based on whatever the school retained in term 1. If a student withdraws from term 1 and returns in term 2, obviously they're no longer eligible for the full amount. So that's why I think that's the impact. Okay, they said there is an impact, but I think that is the impact, but we'll wait for more guidance on that. And one would hope guidance would come out quickly, considering July 1st is a few weeks away. How to handle summer. I purposely put this in here for any of the people that attended my Eastville webinar, by raise of hands, who attended my Eastville webinar. Okay, I have one person. Good job. I was unclear at that time how to handle summer. I am now clear on it. So let me explain that. Just because, for Chris's edification alone, I want to explain that. Okay, if you have a required summer, and this is really another important point I'm going to come back to, but if you have a required summer and it's part of, let's say, summer, fall, winter, spring, or whatever your terms are, as a header, or it could be a trailer. Let's say you're a traditional fall, spring, and you have summer as a trailer, but you include summer as part of the other 2 semesters. And again, I'm talking about semesters, same thing with trimesters and quarters, et cetera. So in that case, if a student's taking, let's say, 12 credits, and 12 credits, but the summer was not required, so you take your 24 credits for fall and spring. Let's call it a trailer for purpose of clarity. So for fall and spring, 12 credits and 12 credits is 24 as your full-time load. Summer is not a required semester. So you can then add the number of credits taken in summer and bring it back into the calculation to make it, if it was less than 24 credits between fall and spring, summer brings it to 24 credits total, you don't no longer have a SOAR calculation. If summer is a required semester, then that's no longer the case. Now it becomes 12 plus 12 plus 12, and it's 36 credits, and the number of credits taken over is your numerator, over the denominator, and that is your SOAR calculation. Okay, was that relatively clear? Cool. Oh, well, so what I also wanted to mention is that, I knew I was going to forget to say it, but I didn't, is that schools that have summer standalone programs and have done loans for summer standalone programs, which personally, I don't understand. I don't understand that at all, but I did research it for one school that I'm working for, and they're not out of compliance. They actually can do that. You could have had a summer loan program not part of a SAY or a BBAY and receive financial aid for it and didn't have to be attached to any of your terms. That's no longer the case because of SOAR. So if you have a program like that, you no longer can have a program like that. That's not very well talked about or known, so that's something also to be very much aware of. If you have a summer loan program that you're making loans for just by that summer, you cannot do that effective July 1st. Oh. And this is where you can find a recording of the training that I did for ISFA. It's on the NYSFA website, NYSFA.org. Go to training, free webinars, free webinar archives, and there it is, all 2.5 hours of it if you're interested, or your financial aid people have not seen anything like it. I highly recommend it because it gets into a lot of complications. I think I had about 17 examples, and people still had questions of things I didn't cover. So obviously, I'm not covering that here in that kind of detail. So you should be analyzing, what should you be doing now? Okay, you should be analyzing what percentage of your students are part-time, what percentage of those students have counted on 100% of the loan eligibility to be able to afford school. Again, this is something, if you haven't done it yet, go make that phone call, because this is going to impact your students and your student body and your bottom line and all those other wonderful things that we talk about when we're trying to get students through the door. Okay? So that's really, really important. Also, what should be discussed, I thought I had it here as the next slide, but I don't, is this should be discussed with everybody. Okay, admissions has to have a whole new conversation with part-time students than they ever did before. Registrar becomes involved because they're the ones that are letting students drop the course or adding a course, because, as I said earlier, having the ability to have the impact in term 1 instead of term 2, as the department wants, is not good for the student and not good for the schools. That's because you could remediate that. A student taking 12 and 12, okay, can now add a credit in the second semester, and they avoid the SOAR calculation entirely. If you have modules, a student who takes a drop in a course in modules can add a module in that same semester, same term, and would not need to have a short calculation. Also, the things that we've discussed, I'm doing a lot of work with Berkeley still, the schools that I retired from, I'm very proud of. One of the things that we discussed is, if we feel the student can handle it, let them register for 15 and 15 instead of 12 and 12. First of all, it gets them graduated faster. And second of all, if they drop a course, there's no sore impact. They could drop a course in either, actually they could drop a course in either semester or 2 courses in 1 semester, and they're fine. Okay, so that's something, but again, you know your students, and you know your students, and you know your students. So the registrar should be able to know whether this student can handle a higher credit load than 12 credits. Alternative funding. That's huge. And what's happening now is that I know for a fact the lenders are getting bombarded with RFIs, RFPs for preferred lender lists. So I'm going to get a little conversation, preferred lender list. Again, I've been financial aid for 50 years, so I've lived through it. And I remember then Attorney General Cuomo and Slate, and I remember Kennedy and the Sunshine Act, and all of a sudden, financial aid people were the real villains in the world. So if you want a preferred lender list, there's 2 ways to do a lender list. One's preferred and one's just a lender list. There's a difference. A preferred lender list, just briefly, you can publish the lenders your students have, and this is the first way to do it. You could publish the lenders your students have been using over the last recommended 3 to 5 years, okay? And you could just present it, just make sure you say, this list contains the students the lenders that have been, students have been borrowing from our institution over the last 3 to 5 years. It's recommended even show the percentage. So if X amount is with Sallie Mae, for example, they're probably the biggest alternative lender out there. So I'll use their name. But then, yes, ma'am.
How would the school have the information on the first bullet point?
Schools know what lenders, what alternative lenders. Yeah, we have that information. Yeah, we have to certify it. Good question, though. Thank you.
Check comes.
And the check comes, but we have to sign off on it. Then for the preferred lender list, which is very, very highly regulated. So if you're going to do this, be very, very, very careful. I'm honored that Will charged me at Berkeley to lead the preferred lender list review, and it was a 3-month process. And it's a process that you have to do every single year. And you have to disclose what you have done and how you did it and why, and it has to be full disclosure in writing, on your websites, in your documentation. So you have to create a committee. It's committee-based. Have to send out requests for RFIs, evaluate and discuss the responses, requesting references and evaluating the responses. Every member of the committee, as well as every student facing financial aid staff member, needs to sign an attestation that they get no benefit from these lenders, and if that should ever change, that they will report it to their immediate supervisor immediately. So not just the people on the committee, but everyone across the board. And honestly, the everyone across the board, I learned when attending a webinar myself. So we went back and redid what we had to do. Okay, we had everyone sign off on it. Documenting all committee activities with minutes and decisions made, and it really has to be diligent, and this is something that is really very regulated. Not that we don't deal in regulations, do we? Preferred lender opportunity pools. Now this is sort of like a contradiction. What's an opportunity pool? An opportunity pool is, a lot of my students don't have good FICO scores, good credit, actually they don't look at FICO scores, I'm wrong, good credit backgrounds. And lenders will not make loans to them unless they have a good cosigner. An opportunity pool says, listen, we'll give you X amount of business, so forth and so on, if you give us, approve X amount of students in this category. And that's what's an opportunity pool up to $1 million, let's say, or et cetera. What's interesting is that this is still compliant, but it's not compliant to have that school on your lender list. So basically, you can't do it, because how are you going to get students to go to that lender if they can't be on your lender list? But you can have an opportunity pool with a school, with a lender, if that lender is not on your lender list. So to me, it seems impossible, but I wanted to make you aware of it. So a preferred lender list is not the magic bullet, because a recent study showed that 40% of all alt loan applicants will be denied. 61% of Pell recipients will be denied. However, some action needs to be taken. You need to take some action, because you're going to find yourself unable to give financial resources to these students, and they'll be unable to attend. So I'm not going to go through this. I grabbed this right off of a federal webinar. This is the kind of materials that you have to have. It says everything I said and a little bit more, how it needs to be presented, et cetera, on your website. It's very, very detailed. I would like to quickly show you this. Donna, could we go live on that link?
Can you go live on that link?
Yeah.
I think so. Give it a shot.
Yes, this is it. Okay, so even though I did work with Will and team at Berkeley College on this, I chose not to publicize Berkeley here. I think it would be inappropriate. So this is Elm Select. Elm Select is easy peasy to work with. Okay, they help you set it up, and what you have is a display of your lenders on your website. It also provides student financial literacy options and things of that nature. And it directs students directly to your lenders. First, you choose a program. I'm not wearing my glasses. I think that's undergraduate. I'll choose that. View loans. And there's Widener's preferred lender list. And if you click on View Loan, it takes into the details. Everything here is the way the federal government wants to see it. So, and full disclosure, Elm Select is not the only option out there. There are other options. Why did I go in that direction? This is the first one I found. And also, I was an original member of the Elm Advisory Board. So just a little side note, Elm's original mission was to get a FAFSA on a floppy disk. Then the department heard about that, said, no, you can't do that. We're going to do something else. And FAFSA on the web was born because of Elm. So I was proud to be part of that. But anyway, let me get back to the presentation. Will, could you bring my glasses or just do it for me? Because I can't see a thing.
I'll be your Vanna White here.
Yeah, thank you. Just get out of that and back into there we go. Thank you. All right, so that's preferred lender list. And honestly, tons of schools are now knocking on the doors of lenders for RFIs and become preferred lenders. So everyone is basically seeing that road as the road to take. More information, again. So basically, again, I'm going to disagree a little bit with the undersecretary. I'm entitled to have my opinion. I believe that the Trump administration, would love to see FELP come back, would love everything to go private again. That's never going to happen, but certainly these regulations, the statute, I should say, is definitely pushing students back into the private sector. And the reason for that, again, they are projected to lose about $197 to $200 billion when it was supposed to make money. That is direct lending. And it's just not what's happening. So, I did have a slide now. So what schools should be doing to prepare? Okay, talk to admissions, academic advisement, bursar, student accounts. Your financial aid staff, of course, needs to be trained. Communicate with your students as soon as possible. I can't emphasize that enough. If you haven't communicated to your students about these changes yet, then you're already behind the curve. So updating your catalog, communicating with your students, making sure your staff is trained. I mean, there's so much to be done in order to, because the other side of this, besides potential of losing students, losing revenue, is being out of compliance. And that's going to be very difficult. SOAR is really, really complicated. When you get down to the nitty-gritty, I only gave you 2 examples. When you get down to the nitty-gritty, it is very complicated. And we're working night and day, and I'm working with several institutions, but a lot with Berkeley on it. And I would say that, again, APC is usually ahead of the curve, so that wouldn't surprise me if you've been doing these things already, but if you haven't, you should be at least. Buy now, pay later. That's an option that a lot of schools should implement if they haven't implemented it already. It's impossible to go onto a website these days without having the option. You can make 4 equal payments without interest. So there are entities out there that could do this for schools. So that is an option. If you haven't pursued that option or thought of that option, I put that into your thinking cap as well. The change in the student loan repayment landscape, that's been covered already today, so I don't want to get into a whole bunch of this, but the important thing to me is that, and it was mentioned that they're going to have 90 days after July 1st, that brings us into beginning of September, I think, to make a decision, or they're going to be put in the regular tiered but regular repayment schedule when they have the possibility of going into RAP, which is the one real option that's going to remain. There's going to be some grandfathering of the SAVE program, but not much. So that would be my recommendation there. Again, we covered this quite a bit earlier, so I'm not going to go into it. Back to cohort default rates. Makes you shiver a little bit, doesn't it? I know it makes me shiver. Where the market currently is, there's approximately 1 million defaults in Q4 2025 and 2.6 million defaults in Q1 2026 alone is what's expected. 3.6 million cumulative new defaults since late 2025. You may not remember the result of what having larger than a 10% cohort default rate is, but it can be very impactful to your institution. So it's something that you should be very serious about. I personally thought going into, before the One Big Beautiful Bill was finalized, coming out of the House into the Senate, I really thought there was going to be a skin in the game concept and it was going to be based on cohort default rates, but the Senate changed it and it ended up being with the Senate is what they wanted, is what they got, and that's what we're calling our income testing. So it's so concerning, and it's amazing what you could do with AI. I asked AI to create this for me. That's the Department of Education testifying in front of Congress because the Congress just sent a letter, 60 members of Congress sent a letter, just sent them a letter saying, what are we doing about cohort default rates? And the Undersecretary did get into that a bit. So I'm glad they're taking that very, very seriously because we have to take it seriously, they have to take it seriously. It's not just our problem. So immediately, what schools should be doing now is building some sort of dashboard, just knowing where your repayment students are, your students are in repayment, and what kind of concern you actually have at this point. So everyone believes that default rates will continue to rise, and it's becoming an economic nightmare for the entire nation, basically. A $17 trillion portfolio could go into a default. Earning accountability. Now, I'm probably talking about something now that most of you are probably much better educated on than I am, because I'm a lowly financial aid person. Okay, I don't know anything about, well, nothing about academia, but academia is not my thing. So what would it take to create a new program? Could I assume all of you know if your programs are passing or failing? Because I know the department provided that information and APC re-provided that. So if you have a failing program, one of your options is to possibly replace those programs, but you have to make sure it's not the same zip code. Okay? Because if it's the same zip code, you're back into the same square one, because when that program goes down, your new program will go down right with it. So that's just, so again, this is the kind of thing you should be aware of. And again, it's not easy to create a new program overnight, but there's no program has a problem until the actual initial official rates come out. And that's not expected until 27. And then the first impact will be felt in 28. So basically, there's going to be a system called STATS. It's something the department's been talking about for a while. This is where the school is going to have to, you're going to have to disclose if you have a failing program. Students, if it's the same as it was, we haven't got guidance on this yet, if it's the same as was originally projected, you cannot disperse to a student until they go into STATS and confirm that they've seen it. And then, so think about the tracking and the things of that nature and the hold of loans. So again, I haven't heard any new guidance about STATS. STATS is actually a new mnemonic, if you will, added to the list of everything else that we do. So just be aware that that's going to be a huge transparency between you, the student, and the school. So in my understanding, and I could be wrong, as was mentioned earlier today, that you could still be hit for GE. It was my understanding that the new accountability actually replaces GE, FVT, and that it morphed. So I'm going to defer to the lawyers, because they seem to...
I think what the secretary said was that schools could early adopt the new rule
Right.
to get out of GE.
Right.
And he couldn't imagine, he said, any school not adopting.
Understood that, thank you. But it was my understanding before hearing that from the secretary and from the lawyers is that that GE FET basically went away. And I guess that's not the case, and I was wrong. So I've been wrong for my life. The one time I was absolutely right was when I chose my wife. No two ways about that. Is this being recorded? I hope so. Could you send her a copy? I'll give you her text. She knows how I feel about her. So again, you basically know all about this, but the one thing that wasn't mentioned I wanted to bring to your attention is there's a advantage, disadvantage for New York, because they're using, well, it depends where in New York you are. If you're a school in New York City or in Manhattan, and most of your graduates are being employed in Manhattan, okay, then the income is going to be much higher than if you're in, let's say, Saratoga, for example, where it won't be quite as high as New York City. So if they can't get, so they're using New York State's median income, not New York City's, not Saratoga's, New York State's median income. So a school like Berkeley, SVA, Monroe will get hurt by that. Schools in the outer boroughs, upstate, et cetera, will be helped by that. Now they're also saying that if you have less than 50% of your students attending in the state, okay, that could be, your regular students who are driving in from New Jersey or Pennsylvania or wherever, or it could be your online students. That's a bigger lump. That what they'll do is they'll use the national average, not the state average. So that's where I say for New York, that's a winner, because I think the national average of income would be, you know, obviously California is high also, but if you take the national average of income, it's got to be lower than that of New York State. So if you have that situation, just be aware that's what they're going to be doing. Oh, and early implementation, thank you very much. That's what I have here. I highly recommend everyone early implement because it's going to be less data, and now it seems that you'll get stuck back in GE, FET if you report as GE, FET, which I was not aware of. Okay, we discussed this when we'll see our first data. So I would build a earnings risk map, you know, by CIP and credential level and keep an eye on it. You really want to stay on top of this and be prepared. Be always that 2 or 3 steps ahead, which is what APC does. That's what APC schools do. So I'm preaching to the choir. I probably learned it from you guys. Flag your low earnings programs, publish the transparency data, etc. For the sake of time, going through things I think we've already discussed. As I said, launch replacement programs where you still have a chance. And this is going to be the final slide now. Do you have any questions? Yes, sir.
So I'm going to date myself a little bit, because you mentioned, Howard, CDR is above 10%. And so I don't recall whether the 30-day delay on disbursements
Yes.
is still on the books.
It's still on the books.
It's 15%.
It's 15%. Now, I knew I made a mistake when I said it. 15%, and anything over 15%, you have to put a 30-day delay on the disbursement of the loans. So yes, that's still on the books.
Okay.
And I think 1 year of 45%, you're out of the loan program, and 3 years over 15%, you're out of the, or I think it's 3 years over 25%, you're out of the loan program. 30%. Again, my apologies, I didn't study this recently, because I too have been in a bit.
So if there's no forgiveness now or deferment, I think in your presentation earlier, that as of July 1st, there's going to be no, I mean, you could put some on forbearance and then get them out of the default window. But you apparently, as of July 1st, you can't do that anymore, right, Howard?
Well, no, it's my understanding that there is now 2 bites at the apple on getting out of default instead of 1. So there's still that possibility, but the student still has to pursue it. So it's not automatic, let's put it that way. So it's 2 bites of the apple where students can get out of a default and cure their default.
What are the 2 bites?
Oh, bite 1 and bite 2.
Right.
In other words, if they get out of default once, okay, and they're now back in repayments, okay, and they default again, bite number 2. It's the same bite, same measure, same taste, but two different bites. Thanks. Any other questions?
I just wanted to mention, because I know the governor made this a priority, and some of you are familiar with EdCap, which is part of the Community Service Corporation, or I'm not remembering their acronym correctly, but anyways, EdCap got additional funding in the budget to assist schools and students, and if you're not, you may have an in-house team like we do at Monroe, and we have the benefit of a phenomenal leader like
Clem LaPietra, the best in the business.
But we are talking to EdCap as well, and I think it's worth everybody's time to talk to EdCap to see how you can partner and have them assist your students. And they've got great educational information that's up to date on their website about all of the changes that are happening with the repayment options, et cetera. So please check them out and talk to them. And if you need a contact person, happy to help.
Thanks, Chris, that's great. I was not aware of that.
Yeah, I've talked with EdCap as well. I also have their contact info.
Also, I know that HESC is trying to bring back their alternative loan program, which the first time never left the ground, but now maybe it'll have some feet, legs, feet.
It didn't make it into the budget.
It did not. Oh, I'm sorry to hear that. Any other questions, comments, concerns? I know I'm between you and drinking.
Oh, boy.
So with that said, I thank you all.
All right, well, thank you so